Ridham, hi, good morning. It's been a great conference so far, and I wanted to bring back the point you made when you joined us the last time, where you said that 31,000 on the Sensex is a bull case that you lay out, and they were very enthused with that. But now with the right kind of noises that the government is making, do you think we could see 31,000 sooner rather than later?
Yeah. Good morning, Sonia. Good morning, Nimesh. I think the noises are right, but what the market will need is execution. So I think the planning that's going on in Delhi seems to be in the right direction. It's exactly what the market wanted to hear, which in a way is sustaining the current Nifty level, because the Nifty had run up a lot. So you could argue that it would have corrected. The maxim in the market is buy the rumor, sell the news, but it's not sold the news. And I think the reason why it's not sold the news is because all the vibes that the market is getting from Delhi is that there is a major action plan on the anvil. So I think what will determine how the market behaves over the course of the next few months is precisely the actions that the government takes. So the planning is one thing which will sustain the Nifty at these levels, and then when the action rolls out, I think that will determine how the market behaves.
So, Ridham, in that case, I read your report as well, where you've been saying that one should look to buy the dips. Is that a strategy that investors should take from here till budget, even beyond budget till the end of this year?
See, I think, Nimesh, you need to sit back, and especially the retail investors who are watching this program, and not get too cheeky about this. Okay, you're not going to be able to catch these dips as smartly as you think you can. It's probable, and we'll never know for sure, only in hindsight we know, is that we are going to get a lot of returns from equities unlike the last 5-6 years. So it is possibly the start of a new bull market, which therefore means that the markets can go up a lot. In such a situation, given especially what investors in India are currently and how they are positioned, they want to actually keep buying equities. So you want to buy the market. You can wait for the dip and get smart about the timing, or as I prefer, just systematically buy equities on a daily, weekly, monthly basis. Because otherwise you look back and say, if the markets go up, like if you look back in the last 3 months, it becomes very difficult to buy stocks, because a lot of stocks have doubled, and you look back and say, oh God, I missed this thing. You have to de-anchor yourself, because you have to assess the stock at today's price, determine whether there's value, and then buy it, and forget what it was 3 months ago, because that price may not come back in a hurry. Unless something catastrophic happens in the world, or we get a major policy failure. So those are tail risks and very difficult to predetermine. So I think what retail investors should do is basically keep buying the market. Institutional investors, of course, are much smarter, and they can time it better, and they can wait for the dip. So my advice, or the advice that we issue, is largely targeted at institutional investors, and I think retail investors should just be buying the market.
So from a retail point of view, Ridham, you believe this is a multi-year bull market, and every level investors should allocate now equity as an asset class? Because I believe, if you look at the whole financial exposure of retail into this market is very, very less. People have just got into real estate and gold in the last 5 years. So is this a multi-year bull market which people now should participate, and especially retail investors should buy equity as an asset class?
So I'll qualify my view, because I'm almost always bullish on equities. So I love equities as an asset class. So I rarely would advise somebody to stay out of it. But you're absolutely right. The point that we're making is that the ownership of equities in domestic portfolios is at historical lows. Investors have stayed away from the asset class primarily because real rates have been negative, and real rates are now positive. So I expect the asset allocation shift away from property, gold, i.e. physical assets, to financial assets, deposits, equities. Now within that, equities is the best performing asset class on a trailing 1-2 year basis, and that's what retail investors do. They react to trailing returns. They see returns are going up, they start investing. So equities, I think, will become the preferred financial asset class. In fact, my view is that we should not even worry about what foreign investors will do over the course of the next 2 years, because domestic investors will buy enough stock. And unless we get a massive surge in supply, it's probably going to imply net demand for equities. So I think that is certainly my view.
Okay. What did you make of the RBI policy yesterday, and the fact that at some level the tone was a bit more dovish that the RBI governor had laid out? Do you think that aided equity sentiment in any way, the fact that there could be a little bit opening up of credit to the corporate sector?
Actually, Sonia, I think if the RBI acts dovishly, it will be bad for the markets. So you don't want an interest rate cut right now. What the market needs is higher real rates. It needs a change in the savings behavior of this economy. Higher real rates will propel equity. So what it actually needs is lower inflation. But one of the ways to get to lower inflation is keeping interest rates where they are and not cutting them too soon. The other thing that needs to complement that is serious fiscal consolidation. So the government needs to supplement the RBI's efforts with fiscal consolidation. I think the central bank is very clear about its inflation targets, and it has not got there. So there's no reason for the central bank to change its view on rates. In fact, we don't think it will change its view into maybe early next year. So that's when we think the first rate cut will come. Now, you made a very important point about credit growth. Okay, so let's examine that. The private balance sheet today has its highest debt equity ratio in history. So it has no capacity to borrow. Banks are almost maxed out on the LD ratio. So they have no capacity to lend. If the borrower doesn't have capacity to borrow, the lender doesn't have capacity to lend, cutting the price of money will not trigger credit growth. Okay? So what we need to do is create capacity to borrow and lend. So the private sector needs to get delevered. For that, profits need to rise, capacity utilization needs to rise, and the banking sector needs to see a fall in the LD ratio, which should ideally happen with higher deposit growth, for which you need to compensate depositors with a real return. So they need to have a return which is above the rate of inflation, so that they feel that, yes, I'm going to create wealth by investing in deposits. So when that happens, that's when a new credit cycle will take shape.
Okay.
Cutting the price of money I don't think will help. It will actually upset this balance that we are now achieving, which is that inflation is trending lower.
Alright, so let's cater to the retail audience. The 80% of viewers that we have are retail. So what are you advising investors to buy at this point in time? I mean, we went through it the last time, but things have changed so much. There's so many talks of reforms. There's FDI in insurance, etc. that's come through. What are the pockets to look at right now?
So I think cyclicals is clearly a place, and I worry sometimes that there's too much of consensus around it. But I think occasionally it's okay to be with the consensus. It's not always necessary that you have to be against the consensus. So cyclicals is a good place to be. I think the valuations are still attractive. You can take auto stocks, auto ancillaries, energy, materials, the private banks, the non-banking finance companies. I think all look still quite okay to buy. What we don't like, I think, is consumer staples. That sector is sitting at all-time high margins and near all-time high valuations. So it has underperformed, but I think that underperformance will continue. So you have to be very selective with staples. Technology, I think, looks very interesting for a longer-term investor. It may not turn around in, say, the next 3-4 months, but we are pretty gung-ho about US growth, and that will feed into tech earnings. I don't expect the currency to appreciate a whole lot. I think it will be inconsistent for us to expect that. The central bank will probably keep intervening to ensure that the currency trades at close to fair value and doesn't get overvalued, because that will upset India's growth recovery prospects. So the currency doesn't appreciate a whole lot, tech earnings come through, and the valuations look quite attractive. So I think technology could be the only contra bet that you want to make, because that's the one sector that is actually doing quite poorly. I am worried about industrials. I know everybody is very bulled up. The stocks have gone up a lot. I think a capex cycle will not come so quickly. In fact, it's not the need of the hour at all. What we need to do is fix the projects that are stuck rather than engineer a new capex cycle. And a capex cycle comes only when the savings rate has gone up. Today we are still running a savings deficit, which is a current account deficit. It's difficult to imagine that a new investment cycle will surge at this stage. If you look at it from a firm level perspective, bottom up perspective, firms are not making enough profits. In fact, margins are at all-time lows. Capacity utilization is low. And, well, confidence has gone up, but the other two things are still not there for a new capex cycle to come. So I think capex will take time. Industrial stocks have run up as though the capex cycle is coming in the next 1 or 2 quarters. So I think you have to be careful about industrials. And I believe you'll get a better opportunity, at least relative to energy, materials, autos. I think you want to differentiate between these three sectors versus industrials.
So, you must have met a lot of investors at a conference as well. Has shift from defensives to cyclicals already happened? At what level they are? And what I want to ask is, as you rightly said, already we've seen a bit of outperformance of cyclicals since the beginning of this year. How much more juice is left? I mean, in terms of ownership and even in terms of participation by the larger audience.
See, I've seen the data from December to May. and also from April to May, two periods, okay, because April to May was slightly different from December to May. The shift is happening, but it's not happened fully. Okay. So it's still underway.
That's what I wanted to ask, whether it's fully happened or...
The only sector that foreign investors we are talking about, right, who have sold down is technology.
Okay.
They've bought everything else, including staples.
Okay.
Okay, so it's not, but they're buying, of course, more of banks and less of staples, but they're still net buyers of staples. Okay, so they have not sold defensives, and the shift is still underway. When I look at the relative valuations, there still seems upside in cyclicals, which is another way of seeing whether the market has fully accounted for the change in, the likely change in the cyclical part of the economy. So I think there's still some room to go. Those portfolio shifts are still happening. In fact, I think that is why the Nifty is not making enough progress. So we had that one odd day last week when the staple stock shot up. And the comment I had was that if it's, this is a sign that this could be a bull market. Because in a bull market what happens is that the first all the favored sectors go up. Then the ones that are left behind, go up when the favored sectors are correcting. And they play catch up. And then again the favored sectors start, resume their rally. So I think we got that episode last week. And I think you'll keep getting those episodes. So it's not that if this is a bull market, then you're not going to lose money in staples. You're only going to underperform. So that's very different from losing money.
I want to ask you about autos, because that's one sector where, we heard Jonathan yesterday saying he's bullish on Maruti. You replaced Hero Honda with Z in your focus list the day before. What's the view on the auto sector? Because that's something which has already performed. And from a valuation point of view, you think there is still juice left?
Certainly, I think. In fact, we did a small analysis earlier this week on Monday, in which what we did was, and I'll try and simplify this, is I assume that Indian earnings will grow at 15% over the next 10 years, which is what we are arguing in the Next India report, which is based on our top-down forecast of 12% nominal GDP growth. And given that the starting level of margins are low, profit growth may marginally outperform nominal GDP growth. Now, if you assume that India is trading at about 4.5 times 2024 earnings right now, okay? Now, if I plug that into all other markets and all other sectors, so if all markets in the world have to trade at 4.5 times 2025 earnings, what earnings growth they will have to generate in the next 10 years? Most markets will have to accelerate their growth from the previous 10 years. And it looks quite unlikely that they will be able to achieve that. So it puts into context India's long-term valuations. Because mind you, in the short run, valuations do look a little rich. But if you go beyond the short run and take a 3, 4, 5-year view...
A little rich? I think they look very rich at this point.
We'll come to that. We'll come to that. And then I did it at the sector level. The striking thing about sector level is that consumer staples will have to grow significantly faster, almost twice the pace that they have done in the last 10 years in order to trade at the market multiple in 10 years from now. Consumer discretionary, i.e. autos, will not have to do that. So I still think that autos, despite the fact that they have done well, still offer better value than staples. So it's a long-winded answer to your question, but I think autos are still okay. Now, a bit expensive. I think there are ways of looking at the market. And I think I made this point earlier, that in 2009, when the election results are happening...
The reason I asked is because when everyone starts to get bullish, I think you should be a little fearful. So has that fear seeped in a little bit yet?
No, I'm always fearful. Because you never know when the next episode comes and the market takes a knock. Especially for people who are focused on making money in a 3 or 6 month time frame. That fear should always remain. Those who are looking at it from a 3 to 5 year perspective, I think will be okay. You can look through these 10-15% corrections that come through and still end up making decent money. But yeah, the valuations at this stage are not as attractive as they were last year. So obviously they're not, right? Because the market is expecting change now. The market thinks the earning cycle has changed, and therefore it's bidding up share prices. I'm particularly concerned about the gap between equity and bond valuations. It's really widened, and it kind of suggests that the bond market does not believe inflation is coming down, whereas the equity markets is of the view that inflation is done and dusted. Now, if the bond markets are right, the Nifty is going to go to my bear case. If the equity markets are right, the bond yields are going to fall. So one of the things people want to buy, in addition to equities, is the long bond. Because I think there's a chance that the bond markets are being a little too conservative. There's a chance. We'll see. But that could be, one trade which could probably generate attractive returns.
All right, Ridham, we'll take this conversation offline, but I need to toss it back to the students. so much for your thoughts. Lata, it's back to you.